Alright, so today I wanted to make a video on Southern Copper. This is a company I've never talked about before, at least never made a video on. First things first, if you get value out of this video, please like and subscribe. I really appreciate that. So a lot of people are talking about artificial intelligence and data centers and this kind of theme when it comes to investing. And something that I think a lot of people miss when it comes to these larger themes when it comes to investing is the picks and shovels play, in that the picks and shovels a lot of times is where more money is made. Number one, because people just don't think about it, and number two, the product is not coming to market without the picks and shovels. So when it comes to a company like Southern Copper, well, if we're going to need a lot more electricity, and if we're going to continue to electrify the grid and cars and you name it, well, we're going to need more of what produces electricity. And what is the most abundant and cheap conductor of electricity? Well, that's copper. So that's one of the many reasons that I like Southern Copper. A lot of people hear, or a lot of people think that like lithium and stuff like that is the way to go, and I completely disagree with that for many reasons. I mean, number one, that lithium is a lot easier and to mine than copper. So, and not only that, it's not even as good. So that's why I prefer copper, and I think that Southern Copper is the company that's best positioned to take advantage of said revolution, if you want to put it that way. So getting right into it here, if we look at the insights, profitability is very, very good for this company. Operating margin 45%, net margin 26%, free cash flow 20%, return on invested capital 23%, return on equity 32%, return on assets 15%. Those are all very, very good numbers. That is one of the many reasons that I like this company, because it is one of, if not the most profitable name in the industry. Growth is slowing a little bit, but I think that's mainly due to the price of copper coming down over the last year or two. The balance sheet for this company is very, very good. It is a current ratio of around 3, which is very good. Shares outstanding are basically flat. They're projected to grow earnings 35% next year, which is very, very good. And then the valuation I will get into a little bit later. So let's get into the financials here, which is, again, the bread and butter of a company. So if we look at the income statement here, revenue has grown nicely. It hasn't exploded by any means, but it has grown over time. It has come down over the last few years, but keep in mind that's because commodities prices skyrocketed back then. So that would be expected. So it is going to be a little bit cyclical. That's something that I think people need to realize. But over the long run, I think the demand for copper is going to skyrocket, which is going to increase the price, which is going to make this company do very, very well. So if we look at net income, again, similar story here. It's came down a little bit, but it is still trending up, which I like. Shares outstanding have been completely flat over the last, looks like about 5 or 6 years, 7 years. I expect them to buy back shares again at some point, but with prices coming down a little bit, that's probably not something they'll be doing right now. But I mean, shares outstanding staying exactly where they're at, I'm not overly concerned. Balance sheet, again, like I mentioned, they do have a strong balance sheet. 16.7 billion in assets, 9 billion in liabilities on an $80 billion market cap. That's not concerning at all, in my opinion. And if we look at their profitability metrics, the free cash flow margin is very, very good. Like it went negative about a decade ago, but it's trended up ever since then, and it's stayed very high, even though prices have came down a little bit, which is another thing that I really, really like here. Return on equity, return on invested capital have also stayed very, very good. I mean, 32% is very, very good. Return on invested capital, 21%, also very, very good. Free cash flow per share, that number has trended up over time. It is down from 2021, but it still has trended up. That number trending back up actually looks to be a good sign. And again, like I mentioned earlier, this company has always had a very strong current ratio, which is very, very good to see. Debt is a problem for a lot of companies out there right now, but this is definitely not one of them. If we look at the dividend here, the dividend over the last 3 years has actually gone down, but over the last 5 years and 10 years, it has gone up. Over the short term, the dividend, it might go down a little bit, but I'm not concerned. Over the long run, it probably continues to trend up again, and that's exactly what we've seen. So, and not only that, if you go back, I mean, you go back 10 years, this company, you'd have a 8%, a little over 8% yield on cost. Going back 5 years, you'd have about a 7% yield on cost. So I expect that trend to continue over the long run. Obviously, I have no crystal ball, but that's what I expect to continue. So let's get into the valuation here and try and figure out, okay, well, what is this company worth? Over the last 10 years, they've grown earnings at about 8.5%. They've grown revenue about 6.5%, and they've traded for an average PE of about 25.65. The current ratios, the current PE is about 29.5. If we go back 5 years, it has grown earnings at 14% per year. It has grown, the average PE actually is a little bit lower. So that's a little bit interesting. Over the last 3 years, let's just check that out of curiosity. Earnings have actually came down. Average PE 21.2. So trying to get a valuation on this company definitely is not easy, but I'm going to do my best here. I'm assuming that we're going to grow earnings about 10% per year. Shares outstanding are going to stay consistent. They're going to grow the dividend 5% per year, which I think is conservative, and they're going to trade for a 25 PE. That implies that fair value is about $99 a share, which is about 4% below where it's currently at. So basically, based on my calculations, again, I'm no expert, I'm just guessing here. Based on my calculations, I think this company is about fair value. Now, I think that, if anything, I think they're probably going to grow earnings more than 10% per year, because I think probably maybe 12% is probably more. If I had to gun to my head, that would imply that they're actually undervalued quite significantly, and fair value is about 12% above where it is. Nobody knows. I mean, let's say they grow 10%, but they grow that dividend by 10%. That implies that they're almost exactly fair value. So I think that, in my opinion here, obviously my opinion, anything below $100, at least based on its current value, is a buy. It's currently around $103 a share, give or take, meaning that it's very close to its fair value. Like I mentioned at the start of the video, the reason that I really think this company is overvalued is that we are going to need more electricity. And that not only means we're going to need more data centers, we're going to need more of what produces electricity in the first place. And one of those things is copper. So I think this company is definitely very undervalued, not necessarily based on its current price. Undervalued in the sense that not a lot of people are talking about this. Everybody's talking about artificial intelligence and semiconductors and data centers. But not a lot of people are talking about, okay, what is going to produce that electricity in the first place? And one of the main things for that is copper. So this company is one that I definitely think needs to be on a watch list. And if you can get it below 100, for sure 90 or 95, I definitely would be pulling the trigger. So anytime you see a pullback in this company, I personally am buying. Again, obviously just my opinion here. I personally am buying, and I will continue to do that until we see this company take off. And I think that over the next 5, 10, 20 years, that is going to happen, because we're going to need more electricity, and when we need more electricity, we're going to need more copper, which means a company like this is going to do really, really well. So obviously that is just my 2 cents. Like I mentioned at the start of the video, I'd love to hear other people's comments on the topic. And like I mentioned at the start of the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.